All right, lock in for the next few minutes because what I'm about to walk you through isn't speculation. It's not theory, and it's not another recycled doom storyline designed for clicks. This is a structural breakdown happening right now in commercial real estate, one that has already erased $1.2 trillion in property value and is now sitting on the balance sheets of regional banks that don't have an exit. Commercial real estate values have dropped 40% from the 2022 peak in major metro areas, and the distress is accelerating, not stabilizing. We're watching a slow-motion collapse that most investors won't fully understand until the day their bank sends a letter explaining why their deposits were converted into equity to save the institution. This is the kind of systemic warning that separates people who preserve generational wealth from people who watch it vanish inside a restructuring process they didn't even know was legal. Over the next 27 minutes, I'm going to break down exactly what triggered this 40% crash, why regional banks are holding loans that won't be repaid, and most importantly, the 3 asymmetric plays you need to understand right now to protect your wealth and position yourself on the right side of the biggest distressed asset opportunity since 2008. By the end of this video, you'll have a clear framework that many institutional players are already acting on, while retail is still being told everything's fine. So shut down the distractions, grab a pen, and let's connect the dots the financial media refuses to touch. Before we get into the mechanics of this crash, you need to understand a foundational concept that governs every major real estate collapse in history. It's called the leverage amplification principle, and it explains why real estate doesn't just decline, it implodes. Real estate is fundamentally different from stocks or bonds because almost nobody buys property with cash. They buy with debt, massive debt, usually 60% to 80% loan to value. That means when values fall, the losses aren't linear. They're exponential. If you bought a building for $100 million with $20 million down and $80 million in debt, and that building is now worth $60 million, you didn't lose 40%. You lost your entire $20 million equity, and you still owe the bank $80 million on an asset worth $60 million. You're underwater by $20 million, and that's the moment the keys get handed back to the lender. This isn't a classroom example. This is happening right now across every major U.S. market. And the banks that issued those loans are about to discover their collateral is worth half of what they underwrote it for. The core thesis of this video is simple, but heavy. We're in the late stage of a commercial real estate debt cycle built on zero interest rates, speculative underwriting, and structural assumptions about office usage and retail traffic that have been permanently shattered. This 40% drop is not a temporary correction. It's a repricing to match a new economic reality. And because regional banks hold roughly 70% of commercial real estate debt in this country, their solvency is now directly tied to an asset class collapsing in slow motion. That creates 3 distinct asymmetric opportunities in distressed credit, inflation-levered real assets, and systemic hedges, which I'm going to lay out with precision. But first, you need to understand how we got here because the pattern is unmistakable and it has already played out twice in living memory. Let's start with history, because if you don't study the past, you'll pay full tuition in the present. The first parallel is the savings and loan crisis of the late 1980s and early 1990s. Most people under 40 barely know it happened, but it was the largest U.S. banking collapse until 2008. Between 1986 and 1995, more than 1,000 S&L institutions failed, and taxpayers ate over $130 billion in bailouts, and the mechanism was almost identical to what we're watching today. In the early 1980s, S&Ls issued aggressive commercial real estate loans at low rates, financing office buildings, malls, and apartments, assuming values would keep rising and rates would stay stable. Then Paul Volcker's Federal Reserve raised rates to fight inflation, and suddenly the cost of capital exploded. Properties financed at 8% had to refinance at 15% plus, and the cash flows couldn't carry it. Values collapsed, borrowers defaulted, and the S&Ls were stuck holding real estate worth a fraction of the loan balance. That's when the Resolution Trust Corporation was created, taking over failed institutions and liquidating assets, becoming the largest seller of distressed real estate in American history. Here's the key lesson. Investors who position themselves to buy RTC assets at 30 to 50 cents on the dollar built generational fortunes. Sam Zell, Barry Sternlicht, and many others built empires by understanding one truth. Distress cycles create asymmetric opportunities for people with capital and patience. The playbook is always the same. Leverage magnifies gains on the way up and magnifies losses on the way down. And the institutions holding the debt are always the last to admit the assets are impaired. Now fast forward to 2008 because that crisis is the template regulators are leaning on right now. The 2008 crisis was a real estate crisis. Residential mortgages packaged into securities and sold globally. When home prices fell and subprime borrowers defaulted, the mortgage-backed market froze. Banks didn't know what their assets were worth. They stopped lending to each other. Credit markets seized. The Fed and Treasury responded with the biggest intervention in modern history. TARP, a $700 billion backstop, plus zero interest rates for 7 years. But here's what most people forget. Banks didn't recover because the assets magically recovered. They recovered because the system allowed them to carry impaired assets at inflated values while giving them cheap funding so they could earn their way out over time. That's extend and pretend. And it only works if you have time, if values stabilize or recover, and if rates stay low. We had all three from 2009 to 2021. We don't have them now. Rates have tripled. Values are falling, not rising. And the extend and pretend window is closing because loans are maturing and they can't be refinanced on workable terms. The 2008 lesson is simple. The system will fight like hell to avoid recognizing losses, but eventually the math wins. When $1.5 trillion in commercial real estate debt matures over the next 24 months and the properties are worth 40% less than the loan balances, there is no accounting trick that can erase reality. Losses will surface through defaults, restructurings, or bank failures, and the investors who understand that are positioning for the distressed opportunity that follows. Now let's talk about what's happening right now in 2026 because the data is clear and the parallels are brutal. According to MSCI Real Assets, U.S. commercial real estate values are down roughly 40% from the mid-2022 peak, while office in major cities is down 50% to 60%. This isn't uniform, it's concentrated by asset class and by market. But the direction is the same. Office is the epicenter, because remote and hybrid work aren't a phase. They're a structural shift. Companies that once leased 100,000 square feet are renewing at 50,000 or 60,000. Sublease space is flooding markets like San Francisco, New York, and Seattle. Vacancy rates are pushing into the high teens and low 20s, even for trophy buildings, not just Class B and C. When vacancy hits 20%, rental income often drops below what's needed to service debt, and the property slips into technical default. Even if an owner is still paying by injecting extra capital, most owners aren't injecting capital. They're walking away. Retail is the second category under pressure. Brick-and-mortar retail has been bleeding for a decade, but COVID turned it into a wildfire. Malls, strip centers, big-box locations anchored by department stores are half empty. Anchor tenants like Macy's, JCPenney, and Sears have either collapsed or shut hundreds of locations. And once the anchor leaves, smaller tenants often have co-tenancy clauses that let them break leases, creating a death spiral. A mall's value is its income. When half the stores are vacant, income collapses, and you're left with an asset that becomes functionally unsalvageable. Lenders face a brutal choice: foreclose and own a dead mall with no future use, or extend the loan and pray for a miracle. Most extend because foreclosure forces a loss onto the balance sheet, and regulators are quietly tolerating this as long as the bank stays solvent on paper. The third category under stress is multifamily, specifically Class A luxury apartments financed in 2020 and 2021 at peak valuations, assuming rents would rise forever. In many Sunbelt markets, developers overbuilt. Supply outran demand. Rents are flat or falling. Then stack on higher property taxes, higher insurance, and higher rates on floating debt, and cash flow no longer covers debt service. Owners hand keys back, and lenders discover the building they financed at $250,000 per unit is now worth $180,000 per unit in distress. That's a 30% haircut across thousands of properties. Now here's where it becomes a banking problem. Regional banks, roughly $10 billion to $200 billion in assets, hold around $1.8 trillion in commercial real estate loans. In many cases, that's close to 30% of their total loan books. Big banks like JP Morgan, Bank of America, Wells Fargo have smaller CRE exposure as a percentage of balance sheets because they shifted away after 2008 and leaned more into securitization and advisory. But regional banks doubled down on CRE because it was relationship-based, locally tied, and wildly profitable in the zero-rate era. Now they're holding portfolios where 15% to 20% of loans are non-performing, reworked, or nearing maturity with no refinancing path. Regulators know it, banks know it. The public doesn't, because official non-performing ratios still look fine in the low single digits. That's extend and pretend. As long as a borrower makes some payment, even interest-only or a modified plan, the loan often doesn't get marked as non-performing. But when maturity hits and refinancing fails, the show ends. Here's a concrete example. New York Community Bancorp, exposed to rent-stabilized multifamily in NYC, saw its stock collapse more than 40% in a week in early 2024 after disclosing major CRE losses. It had to raise emergency capital, cut the dividend, and bring in new leadership. That wasn't a liquidity issue, that was a solvency issue driven by real estate losses. And NYCB isn't a unicorn, it's a preview. There are dozens of regional banks with similar exposure. Same maturity wall, same collateral problem. The question isn't if more failures happen, it's how many and how fast. Now let's make it even clearer why this spreads. Commercial real estate loans aren't 30-year fixed mortgages. Most CRE loans are short-term, 5 to 7 years, with balloon payments at maturity. During the term, borrowers pay interest only or partial amortization. But at maturity, the remaining principal comes due. The system assumed borrowers would refinance, rolling debt forward. But refinance needs two things: property value high enough to support the loan lenders willing to underwrite right now for a lot of loans, neither exists. Values are down 40%, so the original loan to value is upside down. And lenders are tightening standards and demanding more equity because they see what's coming. Borrowers get trapped, they can't refinance. They can't sell for enough to pay off debt. And they can't inject enough cash to bridge the gap. So the rational move is default and hand the asset to the lender. And when defaults scale, losses hit bank balance sheets directly. Now connect this to macro. The Fed took rates from near zero in 2021 to above 5% by 2023, the most aggressive tightening in 40 years. That cooled inflation, but it also broke commercial real estate. Higher rates push cap rates higher. The return investors demand to buy real estate. Cap rates up, under values down. Inverse relationship. A property worth $100 million at a 4% cap becomes about $66 million at a 6% cap if income is flat. That's a 34% decline purely from rate math, and that's before you even account for vacancies and rent declines, so the 40% crash isn't mysterious. It's the mathematical result of a 300 basis point move in risk-free rates applied to a leveraged asset class. Meanwhile, inflation has stayed sticky around 3% to 4%. So borrowers pay 7 to 8% debt costs, but only get 2 to 3% rent growth, if they're lucky. Debt service eats cash flow. Equity doesn't build. Values fall. That's a debt trap. Same movie as early 1990s and 2008. Just with higher debt levels, more regional bank concentration, and weaker political appetite for massive bailouts. So what are the three asymmetric plays here? Let's get specific, because this is where theory becomes action. Play number 1. Distressed credit and special situations. As CRE loans default and properties get foreclosed, distressed opportunities explode for investors with capital and expertise. Distressed debt funds are already raising billions to buy non-performing loans from regional banks at 40 to 60 cents on the dollar. They restructure, take control, reposition, or sell, capturing the spread. For retail investors, exposure comes through publicly traded specialty finance vehicles, REIT-like structures, and distressed credit managers positioning for this wave. Many trade at discounts to NAV right now because fear is high. But when the distressed wave hits and capital deploys into quality assets at depressed prices, returns can be asymmetric. This is how fortunes were made in the early 1990s, and again from 2010 to 2012. Play number 2. Precious metals and hard asset inflation hedges. The Fed is boxed in. Keep rates high and you break more banks. Cut rates and restart easing and you reignite inflation. History says they choose inflation over deflation almost every time, because inflation shrinks the real value of debt and keeps the system alive. When the Fed pivots, and they will when banking stress is undeniable, gold and silver can move violently. Central banks added over 1,000 tons of gold in 2023 and 2024, the fastest pace in decades. They're preparing for a monetary reset, and gold is the settlement layer. For individuals, physical gold and silver held outside the banking system is insurance against debasement and systemic risk. Not a trade, insurance. And silver is extra asymmetric because it's both monetary and industrial, with tight supply and rising demand from solar, EVs, and defense. Play number 3. Senior secured debt in essential infrastructure and cash-flowing real assets. Not all real estate is collapsing. Industrial logistics, warehouses, data centers, and certain multifamily in supply-constrained markets are still functioning. The key is senior secured debt, strong collateral, conservative LTV, borrowers with skin in the game. These get paid even in downturns because the cash flows are essential. For retail investors, this can mean private credit funds, BDCs, and senior loan funds focused on first lien, high-quality collateral. Upside isn't explosive, but downside protection is real. And in a distress cycle, preservation matters as much as growth. Now, what do you need to do immediately? Understanding the problem is only half the battle. Step 1. Assess banking exposure. If you have deposits above the FDIC limit of $250,000 at a regional bank, understand what you are, an unsecured creditor if that institution fails. Spread deposits across institutions or move excess into Treasury money market funds holding government securities directly. Step 2. Reduce exposure to CRE and regional bank equity. If you own REITs heavy in office or retail or regional bank stocks with large CRE concentrations, you're holding assets facing structural headwinds. This is not the moment to be a hero. This is the moment to cut risk and redeploy into better risk-reward. Step 3. Build positions in the asymmetric plays. Start with a 10 to 15% allocation to physical precious metals if you don't have one. Track distressed credit funds raising capital now before the distressed wave becomes obvious to everyone, and consider senior secured debt tied to essential real assets that produce cash flow through the cycle. This commercial real estate crash isn't coming. It's already here. That 40% drop is a fact, not a forecast, and regional banks are holding loans that will never be made whole. The only real question is whether you recognize the pattern early enough to protect yourself and position for the opportunity, or whether you wait until headlines confirm what the data has been shouting for months. This isn't about fear. It's about preparation and asymmetric positioning. The wealth transfer is happening right now, and the choices you make this week decide which side of that transfer you end up on.